Hello and welcome to the Outlook by CAP STRAT. Mike, times they are a-changing. A couple of things the market's struggling with here today. One, boy, that recession narrative came on quick. No Fed cut in July, couple of bad jobs numbers. We saw a pretty significant market reaction to that. We'll talk about recession indicators and namely why we don't trust the Sahm rule in today's environment. And two, the great rotation. We've been talking to our viewers for so long about this great rotation. We told them it was going to come on quick. It came on so quick, we are already in phase 2 since our last Outlook video we released. So maybe let's start there. The great rotation, of course, referring to the difference between small value stocks and large growth stocks. What has been happening since we last spoke to our viewers?
The rotation started on July 11th. The catalyst was cooler than expected CPI report, inflation coming in cooler than expected, which cemented the idea of Fed rate cuts are coming. It's just a matter of how much. And that kicked off the first phase of the rotation. If we look at this chart, what we're looking at here is the 15 trading day, so 3-week, total return difference between small value stocks, which are the rotation winners, and mega cap growth stocks, represented by the NASDAQ 100 index, the rotation losers. What you have is in those 15 days ending July 30th, small value outperformed the NASDAQ by over 21%. And to put that into historical perspective, that has only been exceeded twice in history. Both times were during the tech bubble burst. And then to give more context here, this move we saw over 15 days is a 5 standard deviation event, which means that should happen about 1 out of every 3.5 million 15-day periods. Almost never happen.
Right.
So it's statistically significant. It was huge. It was sharp. And like we said, we're already in phase 2 of it. So we want to talk about the different phases because we think there are ultimately 3 phases here. We just have to get through phase 2. But phase 1 was nice.
Yep.
Phase 1 was, that was from July 11th when that CPI report came out through July 23rd. And there it was a lot of short covering in small caps. Russell 2000 value was up almost 11%. And the NASDAQ 100 was only down 4.5%. There wasn't a whole lot of selling of mega cap growth stocks. It was just repositioning and short covering in small value stocks. Very low quality rally. That one, most investors took that in stride. More difficult is phase 2, and we said phase 2 was probably going to be fundamentally driven, and that's when those Magnificent 7 mega cap growth stocks started not living up to the hype. It started with Google reporting earnings after market close on July 23rd, and falling short of very lofty expectations. So since July 23rd, where a number of the Magnificent 7 have missed, there you see the Russell 2000 value down 8.6, the NASDAQ 100 down 9.4. And that phase 2 is the ugly part because if the mega cap growth stocks, the Magnificent 7, are such a huge chunk of market cap weighted indices that when they wobble, the whole market sells off. And so we got to get through this phase 2 period to phase 3, which we think is a recovery where small value outperforms the NASDAQ 100 to the upside, outpaces it. We're not there yet. We're still in phase 2.
Yeah. So a couple of different flavors of this rotation, small value outperforming mega cap growth in both of those phases. But, kind of zooming out here and just revisiting the rationale for the rotation from a long-term valuation perspective. You can see, we've had a little bit of coming back to trend for the NASDAQ 100 lately, but still just ridiculous.
Yeah, I have to put this in, relative to the starting point. We were at such an extreme starting point between how expensive the NASDAQ 100 was relative to trend and how cheap the Russell 2000 value was relative to trend, that even though, small value closed the gap to the tune of 21% in 15 days, it barely makes a difference in terms of the long-term story.
Yeah.
Still, NASDAQ 100, 35% above its long-term trend. If it comes down to trend over the next 5 years and you bought today, you would earn something like 1.9% annualized, which is unacceptable for a long-term investor taking that level of risk. small value, even though you've done well here, you're still 22% below trend. If you catch back up to trend over the next 5 years, you earn 14.5% annualized, which is a handsome reward for the amount of risk you're taking. So that's why we think from a long-term perspective, we're still on the side of favoring small caps. And we're even more excited about it now that the rotation has started.
Yeah. So into phase 2, you mentioned phase 3 earlier.
Mm-hmm.
One of the biggest drivers of when phase 3 comes or how quickly it will come is going to be this recession scare. Are we in a recession or not? How is the Fed going to respond? And the key question of the day, should we trust the Sahm rule? Mm-hmm. So maybe let's start with the Sahm rule and compare it to what we use in our recession signal that we talk about with our viewers frequently, initial and continuing jobless claims.
Yeah, we showed both of them on this chart. The Sahm rule, as a reminder, made famous by Claudia Sahm, who discovered that if you look at the 3-month average of the unemployment rate, if that 3-month average is more than 0.5% above the 1-year low of the unemployment rate, the economy is in recession. And this is historical, extremely reliable. Yep. And so you see that in the light blue. You see the unemployment rate, the 3-month moving average versus the 1-year low. Anytime the light blue line comes through this dashed red line, the Sahm rule would trigger. And you can see how those instances line up with these red shaded areas, which are the actual economic recessions. Great coincident indicator,
right? Not
a forecast, but great at saying, hey, unemployment has risen fast enough in a short enough period of time that the economy is in recession. We are very aware of the Sahm rule. We do not use that in our investment framework. We use our own initial jobless claims signal, which looks at the 12-week moving average of initial jobless claims and says, have they increased 20% or more from the 52-week low? This seems like a bit of
25% or more.
I'm sorry, 25% or more, which this seems like a bit of nuance, but why do we trust our signal more?
Fair question.
Why do we think it's more reliable? There are a few things. One, the frequency of the data. The Sahm rule is based on monthly household employment survey. You get it once a month, and it's during one survey week within the month. So you only get it monthly, and it's only about 1 week. Versus initial jobless claims, we get weekly. So it's superior in that instance, especially when every week counts when you're talking about the market starting to behave as if a recession's coming. The initial quality of the data. The household employment survey is subject to revisions. So it can look like the Sahm rule has triggered today. Next month, it could be revised so that the Sahm rule did not trigger. This has happened multiple times. Initial jobless claims are also subject to revisions, but historically they're very small. So the initial quality of the data is far superior. And then finally, using initial jobless claims, we feel like we get more signal and less noise. Because with initial jobless claims, you're actually measuring, are there individuals in the economy who are losing their jobs? They went from earning an income to not earning an income. And that has knock-on effects for the economy and creates a recession. The Sahm rule, because there's a numerator and a denominator here in the unemployment rate, it can trigger because you have a lot of new entrants into the labor force that weren't previously earning a wage that now are just struggling to find a job. That is a far less dire circumstance for the economy than if individuals are getting laid off in mass.
Losing income that they previously had, right?
And so with all those, that's why we think our initial jobless claim signal is statistically superior. It proves out over time. It's usually ahead of or on time with the Sahm rule with less noise. And you'll notice the key here is, while the Sahm rule has triggered, our initial jobless claim signal has not. So we are at odds with one of the most historically reliable recession signals out there. So we have some explaining to do.
Yeah, it's a fun place to be.
Yep.
And let's dive into some of that noise that you can see in the household survey and the employment picture. Here we're looking at the year-over-year change in the unemployment rate in the blue line, and then the green bars here are those that are newly looking for a job, as you just talked about, new entrants into the labor force, or temporary job losses, which is particularly of note right now.
Mm-hmm. Absolutely, and you'll see the unemployment rate has increased by 0.8% year over year. You compare that to how much of that came from newly looking for a job or temporary job losers. It's 0.6 of the 0.8.
Yeah.
So what seems to be happening here is a lot of folks are coming into the labor force and finding it harder and harder to get a job. They're being counted as unemployed. There's also a lot of statistical and weather-related discrepancies here, particularly in the July employment report.
Right.
Now, the BLS came out and stated that Hurricane Beryl had no discernible impact on the July employment report, and we just disagree. We think if you look at the data on a number of measures, there clearly was an impact. The first place you see it in the household survey, there was a huge jump in temporary job losers during the month of July. The survey period for the household survey was literally when Hurricane Beryl hit landfall, and the state of Texas, 3 million homes were without power. All right. So there were a lot of temporary job losers. They represented almost all of the month-over-month increase in the unemployment rate. So said differently, if you didn't have that huge spike in temporary job losers that most likely came from weather-related factors, the unemployment rate would have stayed at 4.1, and the Sahm rule would not have triggered.
Right.
It was that significant of an impact. And then we also saw it on the establishment survey, where only 114,000 jobs were added in July. However, 461,000 individuals were not at work due to bad weather in July.
Yeah, that's almost as big of a standard deviation event as the rotation.
Exactly. If you look at the average of the last 10 Julys, it's about 37,000.
Yeah.
So there clearly are weather-related factors that we think mean we should take the Sahm rule triggering with a grain of salt, and also the fact that it's not corroborated by our initial jobless claims signal.
Right.
Leads us to believe this could get revised out. It could ultimately be a head fake. And so we're not going all in on the Sahm rule.
Yeah. I don't know who has a tougher stance to justify, us being at odds with the Sahm rule or the BLS saying Hurricane Beryl had no impact on the July jobs report. But let's dive in on the recession signal a little bit more, right? So here's what we've been talking about in the labor market signal. The initial jobless claims, not quite at that 25% level yet, but getting closer.
Mm-hmm.
So still at odds with the Sahm rule. Elsewhere in our signals, yield curve signal remains active. It's been active for some time.
Yep.
Real economy signals starting to get a little close. Heavy truck sales have triggered, new orders to inventory getting close, and even this market stress signal. So even though we're sitting here today saying we're at odds with the Sahm rule, our recession signal is getting close to activating.
Yep. But that's the difference in terms of preparing portfolios.
Right.
If our recession signal activated, there's a very specific course of action that we're going to take in client portfolios. It's not there yet, even though the Sahm rule has triggered. And then going back to those weather-related factors, looking at our labor market signal, initial jobless claims have risen 17.5% from the 52-week low.
Yeah.
Compare that to the 25% signal threshold. But a lot of that also seems to be, the recent uptick seems to be from weather-related factors. If you just isolate the state of Texas,
Right.
the state of Texas over the past month is responsible for almost all of the national increase in initial and continuing jobless claims. Our base case scenario here is that this weak labor market data in July is due to weather-related factors.
Right.
And if it scares the Fed into front-loading interest rate cuts, that could be a great outcome for markets. It could go either way. Like you said, we're really close to signaling here. We're not going to go all in either direction. But if this ends up being weather-related, this will be looked back at as a buying opportunity.
Yeah, that's a very interesting component of this entire situation is we've been talking for some time about how the Fed is behind based on the inertial Taylor rule. So there's a chance this report or these jobs reports turn into a recession, in which case the Fed is very behind, or not, in which case the Fed still has some ground to make up.
Yep.
And either way, cuts are coming. It's just a matter of how fast and how big, and then what the actual economic outcome is. We go from there. But the Fed continues to be late. The picture we're talking about over the past week or so here has just made that more exacerbated.
Right. We have been on the record saying the Fed should have cut in June, and they should have followed through in July. And it's clear now, after that July employment report, if you look at where the unemployment rate is versus long-run targets, if you look at where inflation is relative to long-run targets, the model is saying the Fed is behind by 2 cuts right now. They're behind by almost 2 cuts.
Yeah.
So, with 2020 hindsight, if the Fed would have received the July jobs report before before the FOMC meeting, they would have cut. They would have cut. They're behind, not by too much, and they have plenty of firepower. So how do they catch up? Well, they catch up by cutting 0.5% in September. We're of the opinion right now they don't need to do an emergency cut between now and then. But if the rise in initial jobless claims that we've seen thus far turns out to not be weather related, and they continue to kick up, an emergency rate cut is not off the table. It's not our base case, but it's not off the table. We don't think it's necessary. So they cut 0.5% in September and they front load it. If they can get 1% worth of interest rate cuts in this calendar year, our view is they'll be right back on track. And then they're going to need to follow through with cuts at pretty much every meeting to get close to what the market is already pricing in. So you see now there's a disconnect between what the inertial Taylor rule is saying and how markets are behaving at this moment. Markets are pricing in probably too many rate cuts for the situation. And so, for anybody rushing out there right now to try to add duration, load up on high quality bonds, we think it's too early.
Yeah.
We would want to see our recession signal activate before we went all in on buying fixed income, because yields are a lot lower today than they were a month ago, right?
Yeah.
The price is not exactly right for the risk.
Yeah, exactly. And as you mentioned earlier, we use these jobless claims because we get them weekly. So that allows us to check in on that very regularly. We'll provide an update to our viewers if or when this recession signal does activate. And then we'll talk about how we're positioning portfolios from there.
Yep.
But that will do it for this edition of the Outlook by CAP STRAT. If you have any questions, please feel free to reach out.